Assalamualaikum warahmatullahi ta'ala wabarakatuh. We are the GHG builders. And for this video, we are going to tackle about our financial planning. So for our revenues, we are projecting 12,000 pesos in month one. And with a steady 15% monthly growth, we end the year at around 55,000 in total revenue. For our break even, we hit it in month three. Here's the logic behind it. Our fixed costs are about 8,250 per month, and we make 6,200 pesos profit per unit. That means we only need to sell a little over one unit to cover all costs. Based on our forecast sales, we reached that point between month three and month four, with month three being our break-even month. So next question is, what was the selling price of the COGS? So for our product, the blind glass, we set the selling price at 12,000 pesos per unit. This amount reflects both the value the product delivers and the price point we believe our customers are willing to pay for a high quality adjustable glass whiteboard. On the cost side, our COGS or COGS is 5,800 pesos per unit. This includes the essential component required to produce each unit, the raw materials, the labor needed to assemble it, and all other direct production costs. After covering these expenses, we still maintain a strong margin, which give us enough room for healthy profitability and sustainable operations. Next is for our unit economics. Every time we sell one unit, we earn a profit of 6,200 pesos, which translates to a 51.7% gross margin. This is a strong margin for a physical product, and it tells investors that our pricing and cost structure are both sustainable and scalable. In terms of customer acquisition costs for the CAC, our marketing budget is very lean at 500 pesos per month. So if we acquire even just one customer in a month, our CAC is 500 pesos, which is only 4% of our 12,000 pesos selling price. This shows that we can reach paying customers efficiently without spending heavily on ads. Our salary cost takes up to 20.7% of our total expenses, which is a healthy allocation. It tells investors that we are compensating the team fairly while still keeping operations lean. This balance helps maintain morale and reduces founder burnout without compromising financial stability. Overall, our unit economics shows that the business is profitable on a per unit basis, has an efficient customer acquisition, and maintains responsible cost management, all strong indicators for long-term growth. So our monthly burn rate, which covers salaries, marketing, and interest, is around 8,250 pesos. In the first 3 months, our losses steadily decreased. Month 1 at 2,050 pesos, month 2 at 1,120 pesos, and by month 3, we're almost at break even with just 50 pesos in losses. This means we only need about 3,200 pesos to cover the initial shortfall before the business becomes profitable. Since we already have 30,500 pesos from a combination of loans and personal savings, we are very well capitalized. This strong cash buffer ensures minimal financial risk, allowing us to focus on scaling and hitting growth targets with confidence. So our monthly growth rate is 15%, which is steady and realistic for a manufacturing startup. This rate allows us to scale our production, supply chain, and operations without overwhelming the business. Looking at our operating profit, it rises gradually and consistently each month rather than showing sudden spikes. This steady increase indicates that our growth is controlled, predictable, and sustainable. Exactly what investors wants to see. One important insight we've learned is that paying ourselves as founder slightly reduces net income in the early months. However, this is intentional. It lowers what we call founder risk, meaning we can stay committed, motivated, and financially stable while building the business. In the long term, this strategy strengthens the company's foundation and ensures we can continue growing without disruption. So if I were an investor, I would definitely invest in this venture. First, our financial position is very strong. Our early losses are minimal, around 3,200 pesos, and we already have over 30,000 pesos in capital from a combination of loans and personal savings. This means the risk of running out of cash or facing bankruptcy is extremely low, giving investors confidence that their investment is secure. Second, our growth assumptions are realistic and sustainable. We project we are projecting a 50% month-over-month growth rate, unlike overly ambitious targets like 50%. Manage our supply chain efficiently and maintain product quality without putting the business under undue stress. Third, we have a clear and early path to profitability. Our projection shows we break even as early as month 3, which demonstrates that the business model works and that returns can begin quickly. Early profitability is a strong indicator of both operational efficiency and market demand. Finally, we are responsible and committed founders. Putting our own salaries in the budget shows that we are serious about building a sustainable business. It reduces founder risk, ensures we remain focused and motivated, and signals to investors that the leadership is stable and accountable. Overall, the combination of strong financial stability, realistic and sustainable growth, early profitability, and responsible management makes this venture a highly attractive and low-risk investment opportunity.